All right, let's dive right in. Welcome back to The Explainer. Today, we're opening up a brand new AI investment memo, and we're doing a deep dive into TransUnion, ticker symbol TRU. Now, if you manage a portfolio or you're just hunting for the next smart play in the data and analytics space, you've probably seen this company pop up on your screen as a steady, high-quality compounder. But today, we're going to completely tear apart the underlying numbers and the strategic landscape. We need to figure out if this legacy credit bureau is actually a smart buy right now, or if there are some serious hidden cracks in the foundation.
So here is the million-dollar question we're answering today. Is a skeptical buy the absolute smartest move you can make with TransUnion? Look, management's near-term guidance is pointing to continued high single-digit growth. They are targeting nearly $5 billion in revenue by fiscal year 2026. And honestly, on the surface, that sounds fantastic, right? But does that growth potential actually outweigh the massive fat tail risks hovering over the company right now? We're talking regulatory friction, cybersecurity fallout, and a huge structural shift in the mortgage ecosystem. To figure out if the upside is worth the headache, we first need to understand exactly how this company makes its cash.
Let's start with a really quick background. Think of TransUnion as essentially two totally distinct businesses glued together by a shared data and identity infrastructure. On one hand, you've got the U.S. markets. This is their mature, transaction-heavy credit bureau, and it is deeply tied to cyclical sectors like consumer lending and mortgages. On the other hand, you have their international segment. This is a super diverse portfolio of localized data franchises operating in places like the UK, Canada, India, and Latin America. Now, that international side brings some great geographic diversification, but it also introduces incredibly complex, localized execution and regulatory hurdles. Unsurprisingly, core credit still drives over half of their revenue, but take a look at how the rest of this breaks down. The non-credit solutions, things like fraud, consumer, and marketing, are collectively taking up a massive and increasingly crucial slice of the pie. These segments are strategically vital. Why? Because they actually have the potential to grow faster than core credit, and more importantly, they help de-risk the company from those wild, unpredictable swings in the mortgage cycle. You can clearly see the top line scaling right here. Revenue has been climbing steadily over the last few years alongside pretty stable margins. But follow that bottom row for me, the free cash flow proxy. It is incredibly noisy. Notice how it basically cratered back in 2022 because of elevated capital expenditures and some divestiture effects. And while the recent rebound is undeniably strong, you've got to be cautious here as an investor. This peak conversion might just mean revert as their transformation savings annualize, and, crucially, as compliance and cyber spending inevitably rise.
So how are they fighting off that margin compression? TransUnion is relying heavily on its primary strategic moat and growth engine, the TRU platform. Think of this as their unified enablement platform. The goal here is simple but highly ambitious. They want to migrate all their clunky legacy systems into a single ecosystem to increase product velocity, sustainably drive down unit costs, and push aggressive cross-selling between their credit, fraud, and marketing tools. They've already migrated over 100 U.S. credit customers onto it. Honestly, if you're building a bull case for TransUnion, TRU is the engine driving the whole thing.
But, and this is a big but, that brings us to the underlying tension of the bear case. As the investment memo plainly notes, TransUnion has a massive moat, but that moat is currently under siege from three sides. See, the competitive advantage for a credit bureau isn't just about having the flashiest technology. It's shaped heavily by regulation and oligopoly dynamics. And right now, those external forces are pushing back really hard. Let's break down these three major threats, one by one. Threat number one is quantified right here, 4.4 million. In July 2025, TransUnion suffered a cyber attack. Through a third-party customer support application, bad actors gained access to the personal data of 4.4 million consumers. We're talking highly sensitive stuff: names, dates of birth, social security numbers. Now, even though TransUnion's core credit database itself wasn't directly breached, an exposure of this magnitude is a devastating blow to a business built literally entirely on the secure, trusted handling of consumer data. And this idea right here brilliantly illustrates why that breach matters so much in the long term. For a credit bureau, a cyber attack isn't just a one-time penalty fee you pay and forget about. It introduces an ongoing structural trust tax. When you expose millions of social security numbers, it triggers an absolute cascade of operational friction. You start seeing higher fraud attempts, elevated consumer complaint volumes, and intense, relentless regulatory scrutiny. All of this permanently raises the ongoing cost to serve customers and creates a reputational drag that weakens the core franchise over time.
Now let's stack that up against the second threat. Just look at this multi-year record of relentless enforcement actions coming from the CFPB and the FTC. We are talking about millions and millions of dollars in penalties and consumer redress, specifically tied to how they marketed credit scores and handled tenant screening accuracy. And yeah, while some of these cases were eventually dismissed or settled, this constant regulatory volatility means elevated legal spending isn't a sporadic one-off event. It might just be a permanent tax on their entire business model.
Then we hit the third threat, which is a massive structural shift in the mortgage industry. Historically, mortgage lending required what's called a tri-merge. That simply meant lenders had to pull data from all three major bureaus, including TransUnion. It was guaranteed must-have demand. But regulators are advancing a major shift toward a bi-merge system, where only two bureaus are required. This is literal regulatory demand destruction. It forces the bureaus into a hyper-intense price war just to be included in that two-bureau pull, and it directly threatens TransUnion's historical pricing power.
And compounding all of these operational headaches is their balance sheet risk. TransUnion is carrying over $5.1 billion in debt, with a weighted average interest rate sitting up above 5%. Crucially, almost all of this debt is variable rate. Now, they have hedged roughly 3/4 of it with interest rate swaps to reduce the near-term volatility, but this heavy reliance on leverage still leaves the equity structurally exposed if base rates rise or if credit spreads widen out during an economic downturn.
So, how is the broader market pricing all of this? If we look at a direct peer comparison, Equifax brought in over $6 billion in revenue with margins around 32%. Meanwhile, TransUnion maintains slightly higher margins on a smaller revenue base. On an enterprise value to EBITDA basis, TransUnion absolutely appears cheaper. But let's be real, that discount isn't necessarily a bargain. It heavily prices in the recent cyber incident and all those regulatory trust risks we just unpacked.
Which brings us to the actual valuation. Check out the massive spread in these discounted cash flow scenarios. Compared to the current share price, the bear scenario threatens a really steep 32% downside if growth slows and those compliance costs keep rising. Meanwhile, the bull scenario promises over 50% upside if the mortgage market normalizes and that TRU platform actually succeeds in scaling. For a company historically viewed as a safe, steady compounder, this is an incredibly wide and volatile distribution of potential outcomes.
So taking all of this data into account, what is the definitive actionable verdict from the buy-side memo? It's highly cautious. The recommendation is a buy, but only as a small, catalyst-driven position, meaning 1% or less of your portfolio, and you need explicit risk controls. Look, TransUnion remains a high-quality data franchise, absolutely, but the embedded event risks are just too high right now to treat it as a safe, set-and-forget defensive stock. You have to keep your position small and watch carefully for clean quarters following that cyber attack.
Ultimately, what you really should take away from this explainer is that the rules of the data game are fundamentally changing. So I want to leave you with this final provocative thought. Can TransUnion leverage its new platforms and non-credit solutions fast enough to simply outgrow its trust tax? Or are we witnessing a world where the traditional credit bureau moat is permanently shrinking because of regulatory pressure and cyber vulnerabilities? It is absolutely a question every single investor needs to answer before adding TRU to their portfolio. Thanks for joining me on this deep dive, and as always, keep asking the hard questions. Catch you next time.